So welcome back, ladies and gentlemen. Welcome back. How was your coffee break? You had some interesting conversations? Yeah? You met new people, Mr. Röder?
Definitely. It's been a really good session for the last 2.5 days, or 1.5 days, so it's great.
Okay. Can you hear me? Because I got the idea that my sound system is a bit low. Can you hear me in the back? Yeah? Okay, there it is. Now it's better. That's better. Okay, thank you so much. Okay, well, we're going to the next part, and I would like to introduce Miles, who gave us a great speech before the coffee break, and I would like him to open this second part of the day. Miles.
Thank you. Good morning again. I wanted to just really give you some brief background before we hear from our speakers and what's been happening in order to communication, just to put it in context, really. And I know we heard a bit from Arnold, so I will keep it quite brief. But this all, I mean, from an IWSB perspective, I mean, this all started way back in 2009. So it's not, this is not a new project, and I think the IWSB realized then that there was a strong demand by the investor and user communities for a change in auditor reporting. And this has resulted, of course, in the new and revised auditor reporting standards that were issued in January of this year that are applicable for December 2016 year ends. And Arnold, I think, went through the key elements of that. We talked that we've got the key audit matters, which is those matters that in the auditor's judgment were of most significance in the current audit. Arnold talked about placing the audit opinion first, enhanced reporting on going concern. There's also statements on independence and fulfillment of relevant ethical standards, and also enhanced descriptions of auditor reporting. So that's really what the IWSB has been doing. I think it's also important to say that it was recognised by the European Commission in their Green Paper on audit policy that auditor reporting needed to be enhanced. And this has resulted in new European Union provisions that were introduced with the new directive and regulation, and these are applicable for June 2017 year ends. The Commission and the IWSB were in constant dialogue in ensuring that these European provisions were aligned and so with the global requirements. And I'm pleased to say that we believe that an audit report prepared under ISAs will be compatible with the EU legislation, and auditors who have to comply with both sets of requirements should not need to do two different reports. And I think that was always my worry, that with the EU regulation that we were going to have in Europe two audit reports. And thankfully, through the work of both the Commission and the IWSB, that's not the case. But whilst all this was going on, a number of regulators were also looking at audit reporting in their own countries. In Europe, an approach was already in place in France, and both the UK and the Netherlands have recently introduced new auditor reporting requirements that effectively adopt early many of the areas introduced by the IWSB. In the UK, these new requirements were introduced in 2013, and effectively we've had expanded audit reports on listed companies for the last 2 years. So there's 2 years of experience of this in the UK. In the Netherlands, there was some voluntary adoption in 2013, but full adoption in 2014, again for listed companies. And I do think it's important, and I think we'll hear from our speakers, that the experiences that have been gained in both France, the UK and Netherlands will help other countries in their adoption of the new ISAs and the new EU reporting requirements. And I'm sure this is something that we'll cover as we get into our speakers. So before we start, though, I've just got one quick question that we're going to put up. So how much will the new auditor report change the game? And we're going to come back to this at the end and see how it's changed. So no pressure on the speakers.
we got half of the audience voted, so please activate your Buzzmaster tool again and vote. And as Miles just said, at the end of this cluster of 3 presentations, we will ask this question again and see if there's been a change in your opinion.
Actually, I should vote.
Oh, you use what did you vote at, Miles?
I did 100%.
Okay, okay. Oh yeah, we see you coming in now. Well,
okay.
thank you so
Thank you very much.
Miles, for this excellent scene setting. And we would like to continue with a group of presentations. And we will discussing the topic of auditor communication. What should the auditor be required, requested, or allowed to communicate around the audit process? And will the new audit report change the game? We've got 3 speakers who will address that topic. Our first speaker is Jimmy Dabou, partner at KPMG. Mr. Dabou will give some insight into the UK experience to get a more meaningful audit report. Please give him a big hand. Mr. Dabou.
Thank you very much, and good morning, everyone. I'm not quite sure I can live up to Arnold's build-up of me from earlier this morning. It took me back to Saturday night, and in the UK it was Father's Day on Saturday, and my older daughter took me to a concert. Fortunately, it was music more for my age group than hers. So it was music at the Royal Albert Hall, big orchestra on the theme of space. So we had the theme music to E.T., the theme music to Star Wars, some Holst, etc., etc. And we got to the final encore. And the conductor, who was all done up in his big black tie and usual get-up, stands up, strips off, and there's a big S, and he's wearing his underpants on top of his trousers. I'm afraid I won't be doing that for you today, but it feel a little bit like that from the introduction. Back to more mundane matters, or perhaps not mundane, because actually I think the new audit reporting requirements in the UK did change the game. So as you know, in 2013, it was the UK FRC's objective to really get ahead of the international developments and put the new auditor reporting model into practice in the UK. And I think that was primarily because of the focus on auditor performance during the financial crisis, given the size of our financial sector in the UK, and I think the FRC felt it had to move ahead at that point in time. And so what I'd like to do is just share our experiences, primarily in 2013, the first year of implementation, but I will also talk a little bit about what we did last year as our second year. And hopefully that will give you some insights as to some of the challenges and some of the things you might like to do in terms of implementing ISO 701 in Europe in coming years. Now, importantly for us, and I think this is an important message for regulators generally, our changes were brought in, and at the same time, the FRC made changes to audit committee reporting, which was complementary. And I must say, it did help us in the UK, having that change happen at the same time, and audit committees being focused in the same way. I would say that's not a necessary change, but I think it was very important for us, and it did make things easier. I suspect you'll see something similar in Europe, but I suspect, like us, what you'll see is that the auditor report tends to move first, and audit committee reporting tends to follow along a little bit behind that. I'm sure Stephen Hadrell will talk a little bit more about that this afternoon. So what were we required to do as auditors in 2013 in the UK? Well, interestingly, and in some contrast, I think, to the ISA, the requirements were very, very brief. And we had 3 components that we were asked to report on that were interlinked. The first was to describe the risks of material misstatement that had the greatest effect on our audit strategy and on how we conducted the audit. I think that's very, very similar to the key audit matters in ISO 701. And whilst our standard didn't actually say that those would be a subset of matters we reported to the audit committee in any case, I think in reality that's exactly what they were. Secondly, and this is something that's not in the ISA, we were required to explain how we applied materiality in carrying out our audit. And perhaps most controversially, to actually state the key materiality threshold we used in the audit. And it turned out that that was of real interest to investors, actually. I'll briefly return to their reactions to that later on, and this not really be a focus of what I'm talking about because I'm kind of looking at ISO 701, but I'd be certainly happy to take any questions on that later. The third piece, which was interlinked, was then saying, tell us how you actually scoped your audit. What did you cover? What didn't you? What did you focus on? Where did you go in the world? And so on. And tell us that in the context of the key risks you've already described and materiality. So really giving a better explanation of how the whole audit fits together. My colleagues, when they saw this, I started out with, that's great, I can understand those 3 bits. Now, I'm expecting to see quite a lot of guidance for that. And in fact, the guidance was in reality even shorter. And I'll actually read this out because this was it. It was just 3 very short sentences. So, all these matters should be described, 1, so as to enable a user to understand their significance in the context of the audit of the financial statements as a whole and not as discrete opinions. 2, they need to be specific to the audit entity and not generic or abstract. And 3, they need to complement the financial statements and the audit committee report. And that was it. No further guidance, nothing. And these regulations came into place, if I remember, it was around June or July, and it were applicable to companies operating 30th of September year ends. So not a lot of time to react there. I think by contrast, the IAASB has produced quite a lot more guidance. And I think it's interesting to ask why the FRC might have taken that approach. I think they're on record as saying, first of all, they don't think the standard as it currently is the end game for auditor reporting. It's just a step along the road. And secondly, they recognized that they wanted to stimulate innovation and experimentation between the audit firms and get us to grasp the nettle. And I think we did that as firms, so I think that worked very well. I will return to this theme a little bit later. So what did we do at KPMG to manage this? First of all, actually, what we were worried about. I think we were a little bit worried about litigation risk impacts because, you know, it's clear that in a very binary audit opinion, it's relatively clear what you're giving your views on. As soon as you start exposing in public some of the debates you've inevitably had with the audit committee and with management, we knew there was a risk that would have some unintended consequences. But actually, we didn't worry too much about that. The biggest worry was the short implementation period and actually achieving an appropriate degree of consistency across our client base without making things boilerplate. And we thought that was very important because we knew, particularly in early years, there would be comparisons made company to company, and we didn't want different teams saying the same things in different ways and creating confusion in the marketplace. So we really managed that risk in 2 or 3 ways. We set down a few principles. The first key principle was that we wanted our description of the key risks to make it absolutely clear why for this particular company and in this particular year, what we were describing was in fact a key risk. And we wanted to be really granular about that. So we didn't just want to say revenue recognition is a key risk. We wanted to say something more like the timing of revenue recognition on these long-term contracts is a key risk because they extend out over 20 years and the outcomes are inherently uncertain. Or perhaps in a banking situation, we didn't want to just say it's about bad debts, we all know that. It was about saying in India, in this year, we're looking at the sectors that have been affected by a currency devaluation or those that are exposed to government. And perhaps in South Korea, it was more about consumer credit. So it was about being really explicit about those things. That was the first principle. The second was we wanted to make sure that the description of our procedures was just not a long list like an audit program. What we wanted to really show in describing those steps is how we'd applied skepticism, where we'd gone to look for disconfirming evidence, how we'd used our own experts, and how we'd looked for evidence from outside the entity. And again, this would not be just looking and saying that for a particular impairment risk, we were worried about assumptions. It would be absolutely critical to say which assumptions, why, and what evidence we sought over those. We also thought that in the context of the 3 big requirements we were asked to make here, we would focus on the risks because we thought that would be the most interesting to investors. We try and do what I would call a very good job on materiality, but not go over the top on it. And we would actually provide a description of scope that was focused, particularly because this was aimed at the top end of the market, on describing how our global coverage worked in with the key risks and what the coverage was across the world. And then we, frankly, learnt on the job. We applied these principles across, it was only, I think, 3 September year-end clients we had, worked out what worked, what didn't, and from that drove out what was just 7 pages of guidance in KPMG that we then applied to all our December year-ends. Importantly, we then put in place a central team, and we were talking about looking at, I can't remember what the number was, we were probably looking at around 100 audit opinions we needed to control at this stage. So we put in place a support team. The aim was to drive, again, appropriate consistency, but without boilerplate. And what we tried to do with this group, we had 2 layers of review. The first is the obvious review through DPP, which you'd expect. But I think quite importantly, we then put in place a group of 5 line audit partners who would, between them, review every audit report we were issuing. And that review undertook looking at the audit report, looking at the audit committee report, which was also supposed to talk about the key risks from their perspective, and then looking at the private reporting we did to the audit committee. And that group of partners was there to make sure we were saying the same things the same way, but most importantly, trying to make sure that we were being truly honest in telling the same story outside the company as we told inside the company. So what were the key challenges? I'm afraid I've got quite a long list of key challenges. I'm going to focus on 8 and run through them quite quickly. The first was actually making sure you really only hit the truly significant risks. That was quite a hard thing to put down guidance for, but essentially we came to the conclusion that there would always be at least one. You might think that's obvious, but actually it took a bit of thinking in some cases, because if you're auditing an investment fund, say, with a very simple investments, you could easily conclude that there aren't any particularly high risks there. But we decided, nevertheless, there will always be a most important, so there'd always be one. I mean, as a rule of thumb, we said it would be pretty rare to see more than 4 or 5. And then it was the review process that really policed that. The next principle we had, the second one, was we wouldn't put down as key risks generically the risk of revenue recognition and management override. We knew auditing standards told us those would always be high risks for an auditor, but we decided it wouldn't help to put those down on every single audit report just because of that. Where it was appropriate and relevant for the particular company, of course, we did cover it. Third, we definitely avoided boilerplate language. And it's very easy, I think, for us as a profession to revert to our own kind of language. So we made sure that didn't happen, because that would be counterproductive to the whole change. As said, appropriate degree of consistency. So where we had the same sort of risk for the same companies operating in the same or similar industries, we did try to make sure the way we expressed why that was a risk, if it was industry-based rather than company-based, in a similar way. We did try to describe the audit procedures we applied to those risks in the same sort of way where they were being done in the same way. And as you'd expect, that was the case generally. 5, we wanted to make sure that the description of the risk really drew out why the particular figures in the accounts were either subjective or judgmental, or why it was particularly difficult to gain audit evidence over that particular area. And it was those 2 features that we thought drove something into being a key risk for us. 6, going concern. We've been very used to a model of going concern where there were basically 3 outcomes. The company was going concern and there was no worries about that, and no one said anything in the audit report. The company wasn't a going concern and the accounts were drawn up on the appropriate basis. That's pretty rare. And in the middle, the company has significant doubts over whether it can continue as a going concern. And we've been used to this model for some time. We did come across circumstances where audit teams spent a lot of time working out where you landed, particularly between is it effectively clean or do you have an emphasis of matter? And in effect, you drove out a 4th category, which was it was a significant risk we described in the audit report because we spent so much time on it, but actually we concluded it was still clean. So that was something we kind of learned along the way. We hadn't anticipated that at all, but that's certainly something we learned as we went along. 7, avoiding descriptions that essentially just said, "Trust me, I'm the expert." And you can understand how you could write that very easily in your description of how you carry out your audit. It was all about really trying to make it clear what evidence you were getting. And in some senses, we did find that very difficult. So I think one of the more difficult areas was, for instance, long-term construction contracts in that industry. There's very little external evidence you can lean on for your judgment there. So the reality was it came back very much to auditor judgment based on what management was telling you and your experience and scale and so on. So quite a hard thing to do, but nevertheless something we thought was important. And the final one was really important, obviously, not pulling punches. Was it a big call on two of my clients to have a key risk about bribery and corruption for that company? Yes, it was a very, very big call indeed. It did cause prolonged discussions with the audit committee and management. But at the end of the day, that was good, because what I got out of those discussions was actually a better description of why I thought it was a key risk than I probably had at the outset. And ultimately, I think the companies were relatively comfortable, because at the end of the day, you could point to their own risk disclosures and say, you talk about this too. So what were the reactions? First of all, of managements and boards. Well, I would say actually very largely supportive. They were concerned in some circumstances, such as the bribery issue I described. But, you know, whilst this was true in many aspects, where we could show that their own risks disclosure did or should have covered that area, then they understood it. They were worried where our draft reports effectively said more about some areas than their own accounts did. And what invariably happened there was they improved their own disclosure, we scaled back in the draft audit report, and the outcome was better financial reporting. So I think that's a good spin-off outcome. Audit committees also got worried when they saw that their own descriptions tended to look light relative next to the auditor descriptions. And that's something that I think we've seen them improve, actually, particularly in the second year. And just as an aside, I would say the recent scandal in the UK around Tesco has brought this very much to light and asked a few very interesting questions, because the auditors there, PwC, pointed out as a key audit risk accounting for supplier rebates. And the audit committee in their report effectively said, we've looked at the controls here, we're not really worried about it, and then things go wrong. So I think some very interesting outcomes to be thought through around that. So finally, investors. What did investors think about what happened? After all, these changes are all about what we thought investors wanted as a profession. And I won't steal Hans's thunder here too much, hopefully, but from the UK point of view, they were interested in the slightly different approaches the firms were taking, and that stimulated some discussion. They were very surprised by the size of some of the materiality numbers that were quoted. So one of the early reports that came out in the UK was on our telecoms company Vodafone, and I think the quoted materiality number was £1 billion from memory. Maybe it's 500 million, I can't remember. It was a big number in any case. And it was something they had not contemplated, auditors operating to that size of materiality. And that's caused a lot of thought from them. They were very interested as well in making comparisons between materiality from company to company to company, and indeed between the firms, and the FRC has followed through on that. So I think that investors have learnt a lot. We've actually had an open dialogue now with investors, and by investors here I'm talking about both the analyst community, the people who actually invest the money, and the governance people in some of these houses, about what is an audit. How do you carry it out? What sort of interactions do you have with audit committees? So it's really opened up a new line of conversation. Thinking back to Arnold's audit quality diagram, I think that has added inevitably, considerably to audit quality. I think it's a very early days. I think there's a lot of education for us still to do. But I think it fully justifies the FRC getting ahead of the curve. Even before, though, the standard came into place, at KPMG, we asked ourselves what next, because we did understand this was a road and a journey. Once you've opened the Pandora's box of telling people more outside than just a binary opinion, it can only go on and on and on. You'll never see a way of really reining back. So we thought, what's the next step? And it seemed very clear to us that if you tell people which rocks you're going to look under in a company, and you're going to tell them how you're going to lift those rocks up, the obvious thing to tell people is what you found underneath. So on a very small number of companies, we decided we would field test live, including findings on our audits in our audit reports publicly. interestingly, I think we debated for some little while whether this was a good thing to do or not. And the debate essentially ran, we could talk about that or we could do it. And picking up the theme from yesterday, ultimately we decided, let's just do it, let's start a debate, let's see what happens, because you won't really learn by talking about these things in a theoretical sense. Having decided that, of course, we had to work out how on earth to do it, because there was no guidance, no thinking, no nothing at that stage. We were conscious that as a trial, we'd have to make it meaningful, but it couldn't be too big. We were conscious that we actually had to persuade clients to participate, but we couldn't cherry-pick the easy clients to make that work. We had to create a new language to describe audit findings, because it was not going to be good enough for us to sit and say, this inventory provision is okay or it's not okay, because it's quite clear we have that view from our audit opinion already. So you actually had to take the findings and make them graduated in some way and give a flavour for how aggressive, how conservative perhaps some of the judgments are. So what did we actually do? We decided that the easiest answer was that we'd choose one partner, which was me, to go and talk to all his 3 listed clients and try to persuade them to participate in this field test. And fortunately, they all agreed to that. We did that before they'd seen drafts of the opinions or anything, because we didn't want to contaminate the process in any way by allowing people to withdraw having seen something they didn't like. And in fact, I was actually surprised how easy it was to persuade people it was the right thing to do. We developed inevitably guidance notes and phraseology to use, and we were very careful not to create a new expectation gap, going back again to a theme of earlier this morning, because, it would be very easy to give people the impression you're actually giving opinions on individual bits of the financial statements, and you're absolutely not doing that. You're merely saying this is what we found as part of our bigger audit. So what sorts of things did these findings say? I'll just quote you 5 to give you the kind of example. So number 1, we found some significant errors in calculations, and these were corrected. Number 2, we have found that the amount of tax contingencies was acceptable, though actually somewhat cautious. 3, our testing identified weaknesses in the operation of internal control. 4, these estimates resulted in mildly cautious profit recognition. And 5, things like this estimate was acceptable, though mildly optimistic, resulting in a somewhat lower liability that might otherwise have been the case. So we're trying to give some really tangible views and impressions as to where we think judgments sit. Reactions again. Management and audit committees were immediately accepting, actually. And the primary reason for that was we were saying nothing more than we'd already told them and we'd been telling them for a number of years in our reporting to the audit committee. We used very similar language. You had to tailor it a bit for public use and so on. But they were effectively comfortable with that. And they recognised that we were being balanced in the way we put it forward. We had integrity. We were sensitive and intelligent, because condensing what often is a page of audit committee report into a couple of sentences in a published audit report, again, can lead you to some difficult, unexpected consequences. And I literally had only one minor request for change in words. So, looking forward to the second year, what actually happened? Unsurprisingly, for most of our clients, the key risks didn't change much. Yes, there were new corporate transactions, there might have been a new accounting standard or a new accounting policy, but the main risks stayed the same year on year. What did change, we found, was perhaps how we carried out our audit, and you might describe, therefore, the procedures a little bit differently. And then we were very subtle in some of the changes in wording we used. So if in year 1 we had felt that the company was perhaps tucking some profit away in that year, we'd have been looking for whether they were being too cautious on a particular provision. And if we felt it was being released in the second year, the language would have been saying we were looking for them releasing profit in effect. So we were giving clues to readers through our descriptions of procedures as to what it was we'd find. So in conclusion, was it all worth it? Undoubtedly. I think just the discussion with investors has made it worthwhile. Were there significant challenges? Of course there were. Will we see new and other innovations coming forward in the future? I absolutely think so. I think this will be an ongoing road, and I think firms will continue to innovate. For instance, I've had a lot of interest from investors around audit differences. Might we see disclosure of unadjusted audit differences in audit reports going forward? I'll just leave you with that thought. Thank you.
Thank you. Thank you. What would you have done differently if you had to implement this new kind of reporting again?
That's interesting. I think I'd have loved to have had a little bit more time to think about it, in all honesty, and plan it, because we eventually ended up reviewing quality into things.
Take that time. We come back to that later on the panel. We had a few questions for you coming in, and I like the upper left one from John Capper.
Let's go with that then.
Superman. As an auditor, what superpower would you find most useful?
It's being able to see into people's hearts and minds, isn't it, at the end of the day? That's, I think a lot of the questioning this morning around what are the key skills, it's still back to judgment. It's still, and I'm thinking about some of the discussion yesterday around, changes of auditors and how long it takes you to get to know things. I can get to know a company, its business in a year. You can get to know people in 3 years, probably. And it's the people you need to know and understand to be a really good auditor, I think.
Okay, thank you so much.
Thank
Give
you.
him a big hand. Jamie DeBoo. Our second speaker in this cluster is Philippe Castagnac, CEO and Chairman of Mazars Group. Mr. Castagnac will provide the perspective of an audit partner in preparing for developments in auditor communication. Please welcome him with a big round of applause.
Thank you. Yeah, good morning, everyone. First of all, let me thank you for organizing such an important conference with such difficult topic. And I think it will be great to discuss about these different ideas. So I have some slides. I don't know how it works. Yes, thank you. So auditors' communication, let's see it as a short-term challenge which needs to be analyzed against the backdrop of a long-term vision. And let me explain why. Today, as much as we benefit from the globalized economy framework, it is nevertheless leading us to an increasingly uncertain environment. And with the development of the new economic zones and the speedy advancement of technology, business and accountancy are in a state of constant transition over many years now. This is why credible, high-quality audit reporting that adapts to this perpetually changing environment is needed. And existing shareholders and potential investors reduce the level of uncertainty in their decisions by seeking information they consider to be not only relevant and reliable, but that provides an independent view from an audit firm or audit firms dedicated to public interest. So looking back, before looking forward. Well, before anything, we need to look back to 2008 or even 2002, probably, because it started some years ago, more than a decade ago. And this is probably being the first changes in the communication that were introduced in the audit communications. Of course, crisis in 2008, the last one, has had a lot of consequences due to the fact that the expectation gap was quite clear. Not only some difficulties have not been seen or probably commented, but the way to do it was not so clear. And that's why this crisis was a call for swift and immediate change. And in this call was heard by the European Union, who made a significant move by adopting recently, last year, a regulation and amended directive that addresses, among other things, the need for reinforced and relevant communication by auditors. And just to comment it's this zone, the European zone, is the first one to do so, because we have many other zones in the world that could have done it before, but it started right now with the EU regulation that would be enforceable next year. And so in this regard, the EU has taken a stride by proposing a framework today that aims to provide a high level of assurance to stakeholders by ensuring the quality of financial statements with the introduction of the following measures. A more elaborated audit report is the first one. We are only speaking on communication, we are not on rotation and other things. So these audit reports will require addition to the audit opinion, and auditors have to guarantee their independence, communicate on procedures used by identifying risks, describe any key material misstatements by providing a summary of their response to these risks, and their key observations related to those risks. This, the more significant change in the future audit reports that are required. The second one is additional and more detailed report to the audit committee. And the dialogue between the auditors and the audit committee is reinforced once again. Of course, in the PIEs and the listed companies, a strong communication and a strong debate between the auditors and the members of these audit committees are existing for a while. But now we have to reinforce the written communication and the report that has been that will be done to the audit committee. And if necessary, the competent authority who has access to this report upon request will be also provided with this new information. The third one is about the annual transparency report. It's not a new report, but it will be reinforced by describing the firm's policy concerning the rotation of the key audit partners and staff, the quality control system, the financial information, showing in particular the firm's total turnover as a result of PI audits, audit fees paid by the other entities, and fees for non-audit services. So it's a picture, it's not the full financial accounts, of course, of the audit firms, but it's more significant information on financial reporting of the audit firms. So this could be seen as a good start in addressing the immediate short-term challenge facing the market in terms of communication and information. Enhancing the communicative value of the auditor's report beyond the audit opinion not only increases the quality of the financial statement, but also renders it more user-friendly by serving as a guide in reading the statements, which are often viewed as difficult to understand given the increasing complexity of the financial reporting. In France, because we spoke about the UK experience, and of course in France you know that due to the former crisis, I should say, the Loi de Sécurité Financière in 2005 introduced what we call the justification of assessment. It's not a paragraph in the opinion, it's another paragraph after the opinion, after the clear opinion. It's not a semi-qualification or something like that. It's clear that if the accounts are certified and not qualified, it's clear. But then you have to address in this paragraph for 10 years now, justification of assessments, where auditors are required to identify certain key areas of the financial statements and provide information on the procedures they employed. This practice applies to all entities. It's not only PAs or listed company. Once again, it has been introduced in 2005, so 10 years ago now. The EU regulation, however, limits this practice only to PIEs, and perhaps in the future discussions we could consider expanding the scope of the risk assessment supporting the audit opinion to all entities publishing consolidated financial reports, which would be an intermediary between all financial statements and only the PIE one. I address in this dashboard, I don't know if it's readable on the screen, yeah it is, a tentative of comparison that has been made between the first column, what has been done in France over the last years, which is the justification of assessment, with what is coming from the ISA 700, and what is now extended audit report coming from the further enforceable next year EU regulation. So you see the difference in scope on the first line, it's clear. It's applied in France, it's applied to financial estimates and the auditing standards and audit procedures. So what we have done over the 10 last years, and what I did as a signing partner, is just to explain, due to the business understanding that we have on the firm we are auditing the accounts, what are the key elements that has been taken into consideration, and explain why we agree. Because once again, if we disagree, we have something in the qualification, the first paragraph. So, of course, we agreed if it is only justification of assessment, but we explain why we focus on and what were the driver for the audit, and finally, why we agree that it's okay and without qualification. So it's interesting because in terms of communication, it's not explaining what is the audit, but it's explaining in this specific cases of the company X why we did it, how we did it, and what we concluded in a positive way. So it would be, if you see when we compare, only the most significant risks for ISA 700, and in the EU regulation proposal, not proposal, new regulation, only for the most significant assessed risks of material misstatements, including material misstatements due to fraud. Of course, fraud is also part of the first part in France. So you have no obligation in France to refer to a particular issue in the justification. It's totally free. The auditor is really, the auditor and the signing partner will write it, prepare it, and propose it in his report as he wants. In the other proposed ISA 700 EU regulation, you have no obligation in the EU regulation. You will do what you need to do and must explain why the issue is considered as a CAM in the ISA 700. So to compare this description, you see that a clear reference to the relevant disclosure in the financial statement is needed. So you will not introduce, in your opinion, or in this paragraph, something which is not already done by the management in the report or in the disclosures. So it's a comment and not a new information. You comment something and you say why you agree and why you consider it as a key topic. And this is absolutely the same approach in the three standards. A description of the methodology employed by the auditor, and so we describe why and how we did it. And this is quite consistent with the other approach as well. And a link with the conclusion of the audit report is included in the assessment, because the conclusion of this justification of assessment is more or less that all these items was the basis to form our opinion and to conclude. So once again, it's not a semi-qualification or an additional analysis, it's just to justify the opinion that has been given before this paragraph of justification of assessment. And there is no conclusion included in the ISA 700, and neither nor in the EU regulation. And this is, of course, concise and global justification. The experience over 10 years in France is that it is 1 page, 2 pages as maximum, probably, except in certain very specific circumstances. But it has helped, of course, to better understand why the audit is done in this way and how the conclusion should be understood by the stakeholders. And these, in the ISA 700, this mentioned that no identification of CAM is something that should be done in the future if there is none, and it's not specified in the EU regulation. So this is a tentative of comparison of what has been done over the 10 last years in France due to this law, specific French law on this, and what is now proposed, ISA 700, or what would be done next year with the EU regulation in 2016. I think it was probably interesting to stop 1 minute or two on this, because we have a certain experience in France on this type of information. And of course, to stay in France, once again, I just want to make a comment on the joint audit. It's probably related a little bit on the information as well, but more general, because as you know, for more than 50 or 70 years, I think it's the law in 1935 that introduced the joint audit in France on the consolidated statements. And this is probably, to us, an important guardian of audit quality by safeguarding three underlying principles. The first one is, of course, the competence, by allowing audit committees, or the management, or the stakeholders, the freedom to benefit from the expertise of 2 audit networks or organizations. So, once again, the joint audit is not to do twice, the audit, not at all this one. It is only in the consolidated companies, the companies that have consolidated statements, and you share the audit on the different subsidiaries, but on the key points. at consolidated level on the mother company. Then you have two auditors, and then you have the conclusion done by two teams with two different views, which means that, of course, two audit firms has two different set of rules, set of approach of the audit, and this is the benefit for the audit committee or the stakeholders. You have, of course, the third one, the second one is the independence, by reassuring the audit committee and the investors that the audit opinion they are prepared is complete. And the third one is continuity, because now with the rotation, you have also every 10 or 20 years or 24 years a move in the audit firms, and this is continuity by allowing one firm to pass on their technical knowledge and provide support to the new and incoming firms, and maybe not in the same period if you have two different terms for the audit firm that are rotating. So Joint Audit usually promotes natural rotation of audit firms. We experience in France that 27% of the CAC 40 has changed their auditors in the past 10 years, which is quite a high level of move if we compare to the other markets. And this is, of course, due to the Joint Audit principle. The EU has also recognized that enhancing reporting requirements is only effective within a framework that reinforces communication between auditors and audit committees, which is fundamental in safeguarding against loopholes in the total coverage of compliance. So this dialogue with the audit committee, with the two audit firms, is something that we experience, that I have experienced over 30 years now, and which is really due to the difference of culture. We spoke a lot of culture, and I guess that we have, as auditors, the same global culture, which is independent mindset driven, but we have also different rules, different set of working, and this is the way where the audit committees could benefit from these two approaches. And finally, confidence in financial statement cannot be restored without promoting the transparency of the audit firms. By establishing a transparency report some years ago, it allows to better familiarize with the statutory audit firms carrying out the audit of PIEs, but it can also open an additional line of communication with other concerned stakeholders and have raised awareness on the value of audits. So the transparency report is very clear, and the guidance are done by the different rules that we have in the profession, IFAC or the other one. And from time to time, it's also good to have a more precise annual report, what we did in certain companies in France, such as mine, over more than 10 years now, describing more than this and including the financial statements of the firm to be totally transparent with the market and all the stakeholders. Now, we need guarantee to preserve and to secure the long-term vision. We are committed that the objectives set out by the European Union and view these new measures as a framework that aims to deal with the problems exposed by the crisis. However, this framework should only be considered as a starting point. Today, we need to guarantee the long-term vision within this market that puts into question our preconceived notion of what audits embody in our present and future economic framework. Today, audits are viewed more and more, it was said in the precedent panel, as a commodity by certain stakeholders or the market, rather than an added value service. And we have to fight every day against this notion or concept. If this perception does not change, then it will be difficult to address the topic of enhancing auditor communication to ensure its relevance and its value. This is a fundamental step and a fundamental additional step. As a result of this general growing perception, the recent trend of reducing audit fees is leading us towards a downward spiral that could suggest the decline of audit quality. Fee reductions can pressure auditors to cut corners, which could compromise audit quality, and that's why we have to concentrate on risk approach, tailor-made approach, and technology. And we spoke, you spoke yesterday, unfortunately I was not there, on new technology, which are so key. In addition, this increasingly weak regard for audits can also discourage young talent from joining or continuing their careers within such a profession, which can also have long-term damages. I do believe that we have to retain, not only to attract, but to retain the good and the larger talents that we have in the universities, and to demonstrate that this is a very, as I experienced it 30 years ago, a very open profession to the whole economy, and with a very, very important future for them and development for them. So I think that you want to rush a little bit. So tomorrow's audit, what could it be? We would like tomorrow's audit to develop in a secure multiplayer framework where audits are challenged and innovated in order to keep up with the evolving trends. We would like to see the development of other complementary and substantive reporting practices that take into account financial performance against the backdrop of a wider social, environmental, or economic context. We would like also internal communication channels to further develop and ensure an open dialogue with the shareholders of PIEs by including external audit partners in discussion at board level. This is just a comment. Over the 10 last years, with the development of audit committee, I do believe that the auditors are more and more on the financial and only the financial statements with the audit committee, and less with the other board members on all the topics that are influencing the financial statement. And that's why it's so key that we have also a clear view on this. And finally, and it would be the final point, we would like to ensure transparency by sharing our best practices and maintaining dialogues with various stakeholders to guarantee that the profession is responsive to future economic evolutions. Thank you.
Thank you so much. We had some questions coming in, and I first like to have the question from Henry Irving I. Could joint audits have two extended audit reports? If joint audit is so great, why is it so unpopular outside France? Henry Irving lives in London, so...
I think we are together as friends. So I would say that it's not well understood. And if it's not well understood, is probably that we have not well explained. That's the first point.
Okay.
Yeah, could be. I can recognize this. But there is also some strong lobby against it. And so what I do believe is that it's not, as I said, twice an audit. And it was explained to be twice an audit, or audit twice. So it's not at all this. And in France, it's not mandatory for PIEs or for certain... So it's mandatory when you have consolidated accounts. And so once again, you have two auditors in the mother company. And then you split the audit probably 50-50 or something like that in the subsidiaries. But for the key topics, as I said, for the key topics, the two auditors, the audit committee and the management, are around the table to conclude that the IFRS principle or the analysis of such an issue is really totally agreed under these principles by the two firms, maybe to culture, or to analysis, to reading of the principle. And that's why it's not so popular. Maybe it's not the term, because as you know, there is an option that is proposed by the European Union. Okay. We will see in the coming weeks or days, maybe, because this rush now in the different states, who will choose the option. And with time, and demonstrating that it is something which is useful, probably we will maybe see some developments of it. That's my hope.
Yeah. Thank you for that. Philippe Castagnac. Our third and final speaker, who has exactly 30 seconds for his speech, is Hans Buijsen. He's a quick talker, I hope. He's vice chairman of the Belgian Association of Financial Analytics. Mr. Buijsen will reflect on the new audit report for the investor perspective and address what needs to evolve in other areas of auditor communication. We wish you luck. Thank you.
Well, one thing is for sure, though I am Belgian, not French or UK, I do try to represent users. And if we say users, we mean all kinds of users. And a user is a very tough game. It is not only the analyst, it is not only the investor, large or small, it could also be a credit analyst, it could be an asset manager. And it's a hell of a job to try to figure out what the users really want. I try to do that through my board position within FAS, but also through my board position within EFRAG, where we try to look at a number of very, very important issues that also are of, let's say, crucial importance to the user. Okay, point one. Well, if I look to the new audit standards, one phrase is very, very important. The auditor's report should become more informative. And the question is, if I listen to Jimmy, I can't call you Jimmy, I hope, if I look to a number of field tests that still need to be performed, we could say that the mission has been achieved. Is it perfect? No, it is not perfect. But it is true that if we look back to the different elements, and we look at the topics that are now on the stage, auditor's independence, ethical requirements, key audit matters, what are we looking at, like goodwill, financial instruments, M&A things, communications on significant risks, and this word has been coming up for quite some time, the going concern idea, which needs to be or has been revealed in a lot better way than it was before, the modification of the audit opinion, emphasis on matter paragraphs, and what have you. For investors, analysts, and users, the audits or the new audit reports enhances the credibility of the financial statements. And that is a very important issue. Question is, why now? It enhances, this new audit report enhances the communicative value of it. It increases the attention of management, which is completely true, which helps us users to benefit from those efforts. The reviewed focus of auditors is an important one for us. It does not only look at consolidated statements, financial positions, comprehensive income, changes on equity, cash flows. It goes beyond that, which again, for us as users, means that it will increase the transparency. It will increase the communication between auditors and those charged with governance. And the only benefit of that can be given to, quote-unquote, investors. That is why we are doing this. We're trying to give or provide assurance. But what does the user want? And again, of course, I'm confronted with the fact, what is a user? And it depends very, very differently on the job he's performing. But let's have a look to the analyst. He wants reliable, comparable, and consistent available data. Jimmy has used the 3 words in his speech, and that is true. We want an assurance. We want to be sure that the data that we are using is reliable, is correct, and has been checked. We also need long histories for quantitative analysis as financial analysts. We need a large number of companies to screen on or involve in regression analysis that we can use to tell people, investors, what we think risks in a certain sector, or of a certain stock, in certain, let's say, spheres of materiality are meaning. We want transparency. We want also have transparency on quick outliers, things that suddenly are different within a certain company, within that sector, and understand what that means. Of course, this is already a lot more than what we are finding, tend to find, in an audit report, and that is no criticism. It is logical that the analyst is going to look at a lot more than the audit report. Sell-side analysts quote all the time a lack of detailed information and narrative context, timeliness, trust, and data quality. This is again where the enhancement of the audit report plays a very, very important role. And I'm not an auditor. Though I work for KPMG and Deloitte, I always worked at the user side in corporate finance. Buy-side analysts tell us the current lack of intelligent as reported data requires investors and credit lenders to use standardized data, which is good. But we also need, again, the disclosure side. We need the opinions. We need to know and feel whether what we are seeing and using in our analysis is trustworthy. We look, as buy-side analysts, also at a large number of companies. So reliable information that we can achieve quickly, get quickly, is of importance. And they do use the audit reports all the time, believe me. Okay, I only have 30 seconds, so I have to go quick. So we know that users draw their information from many, many different sources, and we use all kinds of providers of that, but people sometimes, and I heard something in your speech like, we think auditors are boring and all they say is always the same thing. But I have to admit that these reports are used very, very, very oftenly by all analysts and are looked upon as being highly valuable. So we can only welcome the fact that more information is provided and audit reports go into a route of more company-specific, providing us with more reliance and more comfort. We would be crazy not to welcome that idea. So, what does it mean? I understand that for years there has been a very, very strong demand by us in getting more information, more relevant information, information on what audit work exactly has been performed, what were the boundaries, what was checked, what was not checked. Let us try to enhance communications between investors and the auditor, though this might, in certain cases, be a difficult one to achieve. Increasing attention by management, thanks to the fact that the audit report has been increased, and Jimmy gave examples where in certain companies, suddenly the auditor gives more information on a certain topic than the company itself, which for us as an analyst is a good thing, because in the final report, we will find a quote-unquote reporting from the companies with all the information that you have given them, but also with the information that we expect coming up from an audit report, which is, again, a certain advantage that we have. The audit report becomes more meaningful, it becomes entity-specific. The question is, of course, is it sufficient? Ladies and gentlemen, you know, users, the answer is, of course, no. It will never be okay. You know that each time when we come up with something, we will get back and ask you with another question. The problem is, of course, also time. So it's not only about quality, which is the utmost and most important thing. It's also about user-friendliness and quickliness of use, because there are still less and less analysts. If I continue speeches like this, within 20 years, we'll be the only remaining Belgian analyst, I'm afraid. But it means that people get a lot more pressure in providing investors with good advice. So sufficient, no. Many questions still can be asked. Like, should we not think about other forms of communication with the auditor? It's a good question. It's a very good question. The real question is there time? Is there availability? Does this fit within the mission of the auditor and probably also within his budget? Rating or grading systems provided by the auditors. It's a point we've been looking at. This is about quantitative and qualitative analysis. We do look at the audit report as giving us, again, assurance. More frequent auditors reporting. This is a very tough discussion. We had this discussion as well on interim reporting and on management reporting and on quarterly reporting, where all the analysts said, of course we want more. Of course we want more detail. But if we look around, what we see is the other direction. We get less information in quarterly reporting because there's a big cost attached to that. So we need to be realistic on what we want to achieve. Last question, should the auditor only speak to us through the auditor's report, or should there also be other forms of communication? This is also a tough one. You are working for the enterprises in a completely independent role. I mean, if you get already that right, getting the analysts and the investors at the same pace will be a tough one. So, but it's things, again, that we should think about in order to enhance good communication. As a final discussion, you know that within the Belgian Association of Financial Analysts, and already for the 55th time, we are organizing on the 22nd of October the Awards for Best Financial Communication, where we try really as analysts to find what is the information that we use, what is good information, what do we want, and basically, how do the quote-unquote quoted Belgian companies, let's say, provide us with that information. We give 150 points on non-financial information. I didn't touch the topic yet. I'm not going to because there's a timing constraint. But this is an important issue as well, and also an issue that is certainly looked at by the auditors. There's 150 points on financial information coming out of press releases and other financial information, read annual reports. There's 200 points that we provide on the daily contacts with investor relations. So analysts try to speak all day with the companies they're looking at. Analysts love the fact that auditors give more company-specific information because that is what we are looking for. As a closing remark, last year, during that award, we revealed a PwC survey on corporate performance and what do investors want to know. And PwC was highlighting elements of reporting from an investor's point of view, and where organizations may want to focus their improvement efforts. But it was a very nice one. They figured out that higher quality reporting or higher quality corporate reporting suggests higher quality management. I'm going to read this very briefly, it's only one sentence. Based on certain studies, users of companies' reports often correlate quality of reporting with quality of management. Unclear and insufficient information leads to increased uncertainty in analysis performed by reports users and results in an increased risk premium by investors as a consequence. Direct impact can occur on cost of capital as well. On the other hand, companies may want to protect their competitive advantage by not disclosing too much of information which may harm further perspectives. What is your perspective on quality of reporting in general today? I think as auditors you should have an answer on that. And your impression about the companies based on quality of their reporting. Are they correlated? By the way, the survey revealed that it was highly correlated. Quoting one of the survey respondents, a long and rambling report can suggest a lack of management focus. Good reporting, in my view, shows management have good attention to detail. Thank you very much.
Thank you very much for this very clear presentation. When I could give a good financial information prize, I would give it to you. Okay. We had some questions coming in with the Buzzmaster, and I saw a nice question from Ms. Nina Raven, and maybe we can make it a bit bigger. Will increased communication increase the risk of litigations and scrutiny of auditors from analysts?
Well, this is a question for me that is at the heart of this whole discussion. If, as an auditor, you would be afraid that you're going to reveal more information, and as such, analysts could attack you on that, I'm afraid we're not moving in the right direction. And for me, increased communication, if the communication has been done correctly, and I believe that that is the case, I do not see the issue why we would be worried about litigations. The only thing about transparency of information is that it needs to be transparent, wherever and however you provide it with. More transparency can only lead to less mistakes, whatever the form, whatever the substance, whatever the way you do that.
Okay, thank you. Maybe take the other question, who is still reading 600 plus pages of the annual reports? Can you make that a bit bigger, Monique? From our friend Jean-Luc Barlet, who's still running for a guy who asks the most questions. He's doing a very good job.
And I will have to make a very good answer as well.
Yeah, who's still reading 600 plus pages of the annual report, expect for the auditors and lawyer, are financial analysts not relying on automated data, crunching system questionnaires?
Okay. So there's a triple question in here. Point one, do they have enough time to read it? Probably not. Do they want more information? Certainly yes. If you look to the analysts, they even want, and IIRC is a proof of that, they would like to have even more non-financial information than they have today. Again, you have different analysts. If I'm an analyst and I need to quickly give a buyer or seller's advice within 30 minutes, that is going to be a tough one, and you're absolutely right that we love, let's say, data standards that provide us with automated information, structured data, so we don't lose our time in comparing that. But it doesn't mean that the audit report would be less valuable, because what you do exactly is you do part of the work that we should be doing. You provide us with an opinion which is very well elaborated and triggers our attention to certain risks, which of course then we should make the necessary analysis on. So on that side, there might be a problem of 600 pages. Financial analysts, however, could also be corporate finance people. It could also be people that are working on a bank merger. I think those people will read a lot more than these 600 pages.
Thank you so much, Hans. Give him a big applause. Yeah, and have a seat. Well, you remember we started with this question, and we would like to repeat that question. So get your Buzzmaster out, and Monique will put the question on the screen. How much will the new audit report change the game? And we will see what the influence was of these three speeches. So what we're going to do is we're going to let you answer now, and then set this set of data next to the set of data we asked you 40 minutes ago. And then we see if there is something changing in your mindset. Jimmy, do you have the data of the first set in your head already? You work for the right company? Okay, okay. It's not all about numbers. No, exactly. That was what we were talking about. It was a tricky question. Okay, Monique, do we have enough data to put these two columns next to each other? 60 voters. Let's compare. Okay, and now you have to explain to me, Monique, this left one on the screen, is that was before, and here at the right is after. So what we see is that there has been a significant change. Hans, do you see the change in the columns? Okay, when you give a reaction, please talk close to the microphones so everybody could hear you. Okay, well, Hans, could you react on these numbers? What has happened in the three speeches?
I think I might have to push the
button. There you are.
So we now have 44% of people that there's a 60% change, that's right?
Yeah.
We're coming from only 37%.
Well, what you see is different columns. So we see that the 80% column has gone up with 14%.
Yep.
So a lot more people think there will be change in the game. How much will the new audit report change the game? And a lot more people will think the audit report will change the game. So because the numbers got up in the high percentages. So that's the way you can read it. Yeah. Okay. I got some questions for you. Jimmy, we started with this question just after your presentation. And the question was, what would you have done differently if you had to implement this new kind of reporting again? Could you give me one thing which you might have done differently?
Yeah, I think, and it's an innovation that's become more wide in the second year anyway, explaining some of the features like materiality, like scope, in a more graphical way as a better way of communicating, I think would have been one. I think we used a lot too much text probably first time round. I think if we'd had the opportunity to be clear in our audit planning what was going to be in the audit report at the outset, that would have also have helped. I think those are two features, I think. Okay, well, great. Another question for the three of you. Should auditors be allowed to expand on entity-specific topics as required by investors or other key stakeholders? Philippe, could you react on that one?
My first comment would be, do we have a standard or something to answer to this question, because it's a new question and on something different? So if we have standard, I think that an auditor could report according to the standard. Is it okay, not okay, or well understood? If it's a question related to something totally different without any standard that could be applied or understandable, for us, I think it's out of the scope of an auditor.
Okay. Jimmy, could you react on the question?
Yeah, I pretty much agree with that. It almost says anything that is auditable, we could report on. And if that's what people want, ultimately, that's what we can give. And I think, the profession to date, particularly in statutory audit, has been limited very much to doing what the law requires and possibly what stock exchange rules, etc. require. Maybe we could be more responsive.
Okay. Hans?
Twofold, I fully agree with the two speakers that it has to remain within the audit mandate. I mean, that is clear. But however, with one exception, if an auditor, even outside his audit mandate, would find a serious risk in a company, it should be reported, no?
In the audit opinion, then.
Could you repeat that remark, Philippe?
No, I think in this case, it should be included in the audit reporting, or in the audit report. Opinion.
Yeah, Jimmy?
Yeah, no, I would say, I think that's absolutely right for risks to the financial statements. I think there's an interesting question about whether that would expand to other risks, business risks above and beyond that. And I think, interestingly, in the UK, certainly, one of the things the FRC has required us to do more recently is give negative assurance on the whole of the annual report to say whether or not we think, based on the audit work we've done and our knowledge of the company, the annual report as a whole is fair, balanced and understandable. And I'll leave you to work out what fair, balanced and understandable means. But for sure it does mean looking at the risk disclosure the company's given. And if you're aware of other significant risks that aren't there, calling that out. So I think that our regulation has moved us towards that already.
Okay. Okay. Another question, it's quite a long one, so listen carefully. While users of the financial statements have signaled that the auditor's opinion on the financial statement is valued, many have called for the auditor's report to be more informative and relevant. Do you recognize this desire? And do you recognize that different users of audit reports may want different information? Hans.
It'll be very tough to contradict my opening when I was giving a speech. So who's the user is there the question? And absolutely, and that is a problem. Different users will look at different points of elements within the audit report. And as Jimmy also clearly said, and I fully agree to that, we should abstain from the general, like, everything is to be trusted, it's all okay. So you're getting into a more company-specific item, which will lead us to more complicated questions, yes. I'm afraid as users, we would be fully, let's say, in favor of that.
Okay. Yeah. Third question. Outside of auditor reporting, what could you consider important in the field of auditor communication? Jimmy, could you give me one important word, then Philippe, then Hans, and then later on you can react on that one.
So I think Philippe covered this very well in his presentation. I think the firm's transparency reports provide a huge amount of information about the audit firms and how they operate. I think that's very valuable.
Okay. Philippe?
Yeah, maybe some more information on comments, on mandatory comments, on environmental approaches.
Okay. Hans?
I think fully agree with what Jimmy said. There's a number of reportings out of the audit report that will provide you with more information on that. So again, more reporting or other things might be starting to get difficult for the analyst.
Okay. Anyone in the audience who likes to react on these reactions, these three reactions?
Henry Irving from the ICAW. I guess my sort of overall question is more about from the sort of financial analyst side. We talked a lot about the reliability and the sort of comparability of sort of information and the way that sort of audit reports contribute to that. I guess my question is, if that's the case, why do financial analysts focus so much on the adjusted profit measures, which are non-GAAP, non-comparable, and also not checked?
And who do you address this question to? Okay, Hans.
Tough question, I have to admit, and you're right. But again, it depends. It depends on one hand side what goes into the general framework of what they do as financial analysts and where they start asking pinpointed questions. And what they're looking for, of course, and that's because of their time frame and job context, they're looking for the specifics and the things that might be different. And that is why we do tend to give a lot of weight to that. But you're absolutely right. If we discuss about comparability of information, we should be careful. I agree.
Okay. Happy with the answer? Or does this lead to a other question?
well, I mean, I guess what that leads me to think is we talked a lot about fair, balanced, and sort of understandable. You know, the sort of balance question is quite important too, I would have thought, and it's just being able to get beneath the way that sometimes these adjusted profit measures might be seen across the market, with losses being sort of excluded and gains being sort of included more than perhaps you would get in the GAAP numbers. And I was just wondering how readers are meant to factor that in.
Okay.
The last sentence.
Last sentence, bit more loudness.
Okay. So we are getting different measures from different companies, and so how can they all be balanced?
Point one, they can't, that's for sure. And what we try to do while enhancing the transparency is to limit that to a certain extent. Again, however, some analysts will try to get that one information that provides them with more insight than somebody else. But I can hardly believe that this should be the way to move forward.
Okay. We have another question, and could I ask you to go there, because he's right in the middle, the guy in the grey suit, red tie. You've got a question or a remark. Who would you like to address it to?
No, I'd like to address it to Jimmy in the first instance. Jimmy's alluded to the fact that on the front half of the annual report in the UK, we've moved to negative assurance. I'm James Barber at ICAS, and we're very keen in moving the level of assurance on the front half, and indeed on other corporate information. I'd like to ask Jimmy, would it be possible to go beyond the negative assurance in many of the areas that do feature in the front half of the annual report? And what are the areas in particular that it would give you most difficulty if that was to become a reality? Because yesterday was all about change. And I think this is one of the areas we do have to change. The level of subjectivity in financial statements has increased over the years. So you could argue that some of the difficulties in actually establishing judgments on some financial instruments is not that far removed from the step we'll need to take to actually give assurance in some of the more subjective areas in the front half of the annual report. I'd just like to hear your thoughts.
Yeah. I will probably ramble very slightly on this one. I think the starting point is there are such divergent views from people as to the impact of asking for greater assurance on the front half, ranging from the more you do that, the less we'll say, kind of band, through to actually it's a great thing to have. So I think the discussion around it is a difficult one, and no doubt will run for a while. I think there are elements of the front half that I think users ought to require us to provide more assurance on. And I'm thinking about those that are start at the near to the financial statement stuff, such as, I don't know, an order book in a manufacturing company, for instance, which is very forward-looking financial data, and is capable of audit in its own way, and I think is very much used by analysts in valuation principles. I'd have thought they ought to be demanding assurance around that. You can then move that away from that towards other KPIs that are used in the business. So if a business is talking about a particular KPI, it ought to be a measurable item, therefore it ought to be technically capable of being given a greater degree of assurance on in its own way. I think the other areas that we ought to be able to do a really good job on, though I don't know quite what our opinion would look like, would be on the company's risk disclosure, for instance. I think giving the right form of assurance over that could be valuable. And I suspect, though, that the tool we already have in the UK with negative assurance in those areas probably results in that disclosure being as good as it would be if you had positive assurance. So maybe part of it is people understanding really how giving the negative assurance, the quality of information that ultimately provides.
Thank you.
Okay. Well, ladies and gentlemen, I think we should close this topic now. Thank you, gentlemen. Thank you, Jimmy, Philippe, and Hans, for being here with us today. Give them a big round of applause, please.